Trading price action successfully can be complicated, but it is simple if you know some of the factors and rules to follow. So in today's video, I'm going to be sharing 4 price action rules that cannot be ignored. And this is whether you are a seasoned trader or a beginner trader. If you put these rules into practice, you will definitely elevate your trading. Let's waste no time. Let's jump right into it. The very first thing you got to keep in mind is that patience is key. As we dive into some of the other things from a technical standpoint that you got to pay attention to when you are focusing on price action, patience is one of those things that you cannot avoid, whether it is a particular methodology or strategy that you're looking for, or just simply an edge. You have to be patient. Price action requires patience. If you're trading on the 1 hour time frame, it requires patience. If you're trading on the 5-minute time frame, it requires patience, because you cannot succeed as an impulsive trader. So the very first thing I always like to say, I always like to tell trader is you have to make sure you are working on developing a patient mind, a mind that allows you to act effectively when you get the right opportunity. The next rule that cannot be ignored is abstain from trading against the market tides. It is exactly what it sounds, guys. So if you're a swimmer, it is extremely difficult to be swimming in the opposite direction of where the current is flowing. And it is no different as a trader. If you're trading against the trend, it is a lot more difficult and it is not sustainable, because a lot of traders will say, hey, I make money counter trend trading. I don't see anything wrong with it. That is absolutely correct, right? You can make money counter trend trading. What I always say is that you can lose money doing the right thing in the market, maybe once, twice, maybe 3 times, a couple of times, but over a long period of time, you will make money. At the same time, you can make money doing the wrong thing in the market multiple times, but over a period of time, over the long haul, you will lose money. So let's go over to the chart here, and I'm going to show you what this looks like from a technical standpoint. So taking a look at the chart, guys, over here we see that price is making higher highs and higher lows, and the market is moving in a bullish fashion. We see that the strength is clearly up. The trend is to the upside. Now, if you were to buy, let's say right here, for price to continue moving up, you would have lost money. So that would have been an example of doing the right thing, right? But you lost money. It was just poor timing. But let's say now you decided to go short, which would be the counter trend trade in anticipation that the market is going to continue moving further down. And look at this here. This would have been a perfect example. You would have made money. And also we took this minor low here. This is the 5-minute time frame. So it's also important to note down the higher time frame, the overall trend is up and clearly still in the 5-minute time frame. But if you're paying attention to just the little details here, you might get excited and say, hey, this is time to short. So you might have made money here and the market continues moving down. Okay, now price is moving back up. So maybe you take your profit and you're watching for the market to maybe give you another opportunity to strike again. And right there, it gives you another opportunity and you decide, hey, I'm gonna go short again. And you decide to put a trade in place, and maybe you're just aiming for something small, maybe just before we hit this low. Right? You're not looking for price to take out the low. You just want something small. Let's see if price gives that to you. Perfect. Wow, look at that. Okay. Okay. And okay. There you go. So you get stopped out of the trade because you're swimming against the tide of the market's direction. So it's a classic example, guys, as we go back to the saying is you can lose money doing the right thing, but over a long period of time, you will still win. But on the other hand, you can make money doing the wrong thing, and over a period of time, you will lose. So you have to decide which one of those two you'd like to take home with you. The next major tip is to avoid trading the noise. What the noise simply means is a sideways market. Most traders are aware that there are 3 major market conditions. You have a bullish market, you have a bearish market, and you have a sideways market, which you might call a consolidation, a range-bound market, or some people might call it noise. What I like to call it is accumulation, right? Is the accumulation of orders. And what I like to focus on is the distribution of orders rather than trying to trade the accumulation itself. So let's go over to the chart and see what this looks like. Most traders give back their profits in sideways market. So one of the things that I discovered is that it's better to wait for the accumulation of orders to be completed and then trade the distribution. This right here is the highest point in the market, right? And price is literally essentially moving sideways. So you're focused on the highest point and you're also focused on the lowest point, which would be this low right there. So you're waiting to see what price is going to do. So one of the things I discovered that it's better to just simply wait for price to do its thing, accumulate, and let you know where it's going to be going. So try not to do anything because the next opportunity that comes will actually be a lot more favorable. And what you see here is price breaks out of the consolidation or the accumulation very well, let it move strongly out of it, and then let it trade back into it. So take a look at this, and now you can say, hey, let's go long, place in your stop loss pretty much at the low right there. And maybe you want a 3-to-1 trade, so you can set yourself up, trade price to either like 60 pips or so. Obviously you would use specific levels, but let's say 3-to-1, right? Let's see where price is going. You're looking for 60 pips out of the move, and let's see how well price moves in that overall direction. So relatively quickly, because now the market is moving out of the overall accumulation stage, and now we're seeing price move, boom. So your take profit has been hit, and that's simply what you do. And this is something you can test in pretty much all time frames in different markets to see how well it works, and I'll tell you it works. When it comes to rules that cannot be ignored, one rule that I found that made a huge difference for me when I stopped ignoring it is momentum. Momentum is the rate at which price is moving in any particular direction, and momentum can be a massive thing. If price is moving aggressively up, you don't want to be putting your sells orders in place. Well, unfortunately, a lot of traders, when using things like fibs or even support and resistance, the minute price hits that level, they just put your orders in place. And it's a recipe for disaster, because you have to think from a standpoint of sometimes the market might actually be strong enough to break those levels or to shoot past your support levels, your resistance levels, or even your key areas on your fibs or whatever it is. So finding ways to leverage momentum like candlesticks, right? Watching the volume gives you an edge. Let's take a look at the chart here on how you can pay attention to momentum. Sometimes price could be moving aggressively in a particular direction, and we don't know whether it's going to be stopping or not. And momentum is a way for you to just simply gauge that. So let's take a look at gold, for example. And what we see here is that price is moving down. This candlestick represents strong bearish momentum, right? And when you get momentum moving in one particular direction very strongly, there is a strong possibility that you will likely get a pullback, and you wait for that pullback. So if we plot our fibs from the low to the high here, and a lot of traders will wait for price to maybe just hit your fibs, and then boom, they just get involved in the trade. What I like to do is I like to wait for a shift in momentum, and one way we can see that is watching price, the candlesticks, right? And when you see the candlestick here, this candlestick would be a very powerful representation of the switch. Not only are we moving down with strong bearish momentum and we had a pullback, we've tapped into an area of interest using our fibs, right? We're also getting the candlestick to properly represent that, hey, the market might be ready to continue moving lower. So as a trader, what do? You put your order in and look to target one of the areas in the fibs where I like to take my profit here. Perfect. So within 1, 2, 3, 4 candlesticks, right, our target has been hit, right? So that just tells you the power of momentum. And obviously maybe you might have been able to get in further here, but it's also important to wait for price to tell you what to do. And momentum is just one way you can do that. And that's the video, guys. Thank you for watching. Hope you found the video insightful. On your way out, don't forget to hit the like and subscribe button. Hope you're out there living free, and I shall see you on the next video. Peace.